Today, we're digging into Pagaya, a fintech company making a pretty bold claim that they can find good, credit-worthy people that traditional banks are just missing. So is their AI really a game changer? Is it powerful enough to actually rewrite the rules of lending? Let's get into it.
And yeah, this is the exact question right at the heart of Pagaya's entire mission. Traditional credit models, they could be a bit of a blunt instrument. They often end up overlooking people who are totally capable of paying back a loan. Pagaya is betting that its AI is the fix.
So here's their big idea in a nutshell. They use AI to get a much sharper picture of a borrower's real risk. Then, they basically play matchmaker, connecting the lenders with big institutional investors who actually want to fund the loans. And, this is the most important part, Pagaya doesn't hold on to those loans itself. That little detail completely changes the game.
This is probably the best way to get your head around their model. It's this wild, three-part combination. You've got the Visa part, which is the network connecting everybody. Then you've got the BlackRock part, which is how they package up loans for big investors. And the engine driving the whole thing, that's the powerful fintech AI. It's a pretty potent mix.
Okay, so how does this whole thing actually work? Let's pop the hood and take a look at the engine.
The whole process really works in 3 layers. First up, you've got the originators. Think of your local bank or an auto dealership. They're the ones taking in the loan applications. Second, Pagaya's AI steps in to do the underwriting, and it analyzes way more data than a traditional model ever could. And finally, in the funding layer, all these approved loans get bundled up into what are called asset-backed securities, or ABS, and they're sold off to large investors. Pagaya doesn't hold the risk, it just takes a fee for making it all happen. And this right here really highlights the massive difference. A traditional bank holds the loans, which means it holds all the risk, and it needs a mountain of cash, of capital to grow. Pagaya, on the other hand, is what we call capital light. Since it's not holding the loans, it can scale up its network and its business so much faster, and it doesn't need to raise billions of dollars itself to do it.
So yeah, it's a very clever model, no doubt. But, the ultimate test for any business is simple. Is it profitable? Is this fancy AI-powered network actually translating into real money?
All right, let's turn to the financial scorecard and see what the numbers have to say. First thing you see is revenue. And look, this isn't just growth, it's accelerating growth. The company's year-over-year growth rate basically doubled in just a couple of quarters, jumping from 18% all the way to 36%. That is a really powerful trend, and it shows their network is gaining some serious momentum.
Now this chart, this might be the most important one of all. So many fintech companies just burn cash for years and years, but Pagaya has made that critical turn. They're consistently and increasingly profitable. This isn't just a one-time thing. It's a clear pattern, and that really de-risks the whole story for an investor.
And here is where you see the magic of that capital-light network model. This chart shows adjusted EBITDA. It's a measure of core profitability, and you can see it's growing even faster than the revenue is. That's what's called operating leverage. As more and more business flows through their network, their costs don't go up nearly as fast. And that means profits can really start to take off.
And to top it all off, the company itself is so confident about what's happening that it actually raised its official forecast for the entire year. They're now expecting to bring in as much as $82 million in net income. They've really made the jump from a speculative fintech to a profitable growth company.
Okay, but it can't all be good news, right? No business just has a clear, open field. It's not all smooth sailing. So let's talk about the challenges and the competition Pagaya is facing.
First off, they're not the only game in town when it comes to AI lending. You've got major players like Upstart and SoFi. Pagaya's advantage really comes from its massive data sets and that capital-light structure we talked about. But on the flip side, their brand isn't nearly as well known. And a big one, they are hugely dependent on that market for asset-backed securities, the ABS market. If investors get spooked and stop buying those loan bundles, Pagaya's whole assembly line could grind to a halt.
So the risks really come from a few different directions. In the short term, a recession or a freeze-up in that ABS market could hit them, and hit them hard. Looking out longer term, there's always the threat of new government regulations on how AI can be used in lending. And for anyone actually looking at the stock, well, you gotta know, it is famous for being incredibly volatile.
So you weigh this incredibly powerful business model against some very real risks. Where does our source material land? What's the final verdict? Well, the future could basically play out in one of 3 ways. In the bull case, the best case scenario, Pagaya becomes the dominant AI network in the US. In the bear case, a tough economy hits, credit gets worse, and the business actually shrinks.
But the base case, which is seen as the most likely, paints a future of steady, profitable growth, but with some real bumps along the way because of those economic cycles.
And this quote really sums up the definitive stance from the analysis. The view is long-term bullish, seeing Pagaya as a core pawn piece of the future of lending. But that optimism comes with a huge warning. This is a stock for investors who can really stomach some wild swings and high volatility.
Which leaves us with the final and most important question. Pagaya has proven its AI model works. It's proven it can be profitable, but its destiny is absolutely tied to the health of the broader credit markets. So is this really the future of lending? Or is that unavoidable risk of the economic cycle just too high a price to pay for innovation? That's the billion-dollar question, isn't it?